My name is Jerome Lee and I'm a Forex dealer with Phillip Futures. Welcome to this edition of Phillip Futures webinar. Today we're going to talk about gold. We are currently past the midway point for 2016. So far, this year has proven to be tumultuous for a global economy which has translated to a challenging and difficult 6 months for investors.
Several events have contributed to the global economic uncertainty and contributed to the rocketing prices of gold, which took gold from US $1,064 per ounce to a recent high of US $1,375 per ounce. Adoption of negative interest rate policies by central banks, UK's referendum on its EU membership, the US presidential elections, continued geopolitical unrest in the Middle East. Amidst all this economic and financial uncertainty, gold has surged strongly, rising by more than 30% since the start of 2016. This meteoric rise in the price of the precious metal has further shown that gold continues to thrive during adverse economic conditions. As a recent example, the price of gold soared 6% against the US dollar during the release of the results of the UK's EU referendum. The rapid rise of gold prices during uncertain market conditions makes a strong case that investors the world over continue to see gold as a safety asset. Traditionally, investors have turned to gold as a hedge against political uncertainty, interest rate policies by central banks, volatility of the US dollar, as well as general financial and economic uncertainty. This has proven true to current times, especially when you look at the demand for gold for the first half of 2016. Based on the World Gold Council, investment demands for the precious metal reached 1,064 tons. This is worth $41.6 billion in value in the early half of 2016. In addition, demands of gold for investments have set a near record increase in the second quarter of 2016. This is despite weakness in demands from traditional consumers of gold like China and India in the early half of 2016. There are two reasons why gold continues to stand out as a safety asset for investors during periods of financial instability. Firstly, it is immune to any monetary policy from governments, minimizing any risks or possible interventions as compared to the Japanese yen. Secondly, compared to the quantity of fiat currency which can change as a result of monetary policies, the supply of gold available is much more consistent, as the precious metal is almost indestructible. With the exception of a small amount which is lost, most of the gold that is mined still exists in one form or another. Demand for gold in the latter half of 2016 is expected to increase due to seasonal buying from both China and India, traditionally the two largest consumers of gold. Starting in September, with Indian farmers most likely to buy gold as a form of long-term investment following the autumn festivals and post-harvest of summer crops. While China's gold demand is expected to pick up from the latter months in 2016 to early 2017, prior to the Lunar New Year festive season. In addition to these retail buyers of gold, China and Russia's central bank have been participating in a buying spree of gold, with the People's Bank of China increasing its gold reserve by 70% to about 1,800 tons in 2015, while the Central Bank of Russia increased its gold reserve by 18% to about 1,480 tons. These two segments of gold buyers, both the retail Chinese and Indian gold buyers, as well as the central banks, are generally likely to retain onto their purchased gold, as they tend to be long-term investors. The resultant effect will be a reduction of readily available gold supply, which could in turn create an environment allowing for a continued rise in gold prices due to demand. Aside from its demand as an investment asset, gold is also an integral part in many other aspects of industry. Gold can be found in everyday common objects like jewelry and high-tech electronic circuitry. In fact, there's even ongoing research and development for gold nanotechnology to deliver more effective means of cancer treatment. The fact that gold is ever so present and pervasive in our daily lives means as prices of the metal go up, manufacturers will be pressured to bid for and keep a larger stockpile of gold to hedge against the rising cost of gold as a material. This will further fuel the rise in gold prices. To get an idea of gold movement, on a broad timeline, we can turn to the technical analysis to give us some clues. Looking at a chart of gold price in US dollars, if we were to take the lowest and the highest point of gold in the last 20 years and use those points as reference for Fibonacci retracement, we can see that the downward move in gold prices since 2011 has only been a 50% retracement of this overall upward move. Hence, we can see that on a very broad timeline, The downward move starting from 2013 to 2015 was only a retracement, and the overall upward trend of gold had not been broken and could resume in 2016. If we look at the charts for year to date, gold is still very much above the 200-day moving average and is above previously tested technical supports of 1200, 1250 and 1300. In addition, price is also currently still within the oversold region. This gives it a good case that if prices were to stay above these support levels, we could potentially see gold heading to test the next resistance levels of 1,380, 1,400 and ultimately 1,550 in the long term.
Beyond looking at just the technicals, given that gold is priced in US dollars, it is of no surprise that investors tend to be very sensitive towards any possible data releases, monetary policies, or statements by Federal Reserve officials which can potentially impact the greenback. The next event on the horizon which could potentially drive prices in gold will be upcoming FOMC meetings, where everyone from investors to analysts will be watching to see if the Federal Reserve will hike its rates. Given the hawkish statements by both the Fed Chair Yellen as well as Vice Chairman Fisher, this sends a strong signal that the next releases of numbers coming from the US trending towards the good would then be a good case for a rate hike. If the Federal Reserve decides to hike its rates, the US dollar will strengthen. This will cause price of gold to fall in relation. However, this does not necessarily spell disaster for the precious metal, as investors looking at the long term could take this as opportunity to capitalize on the falling gold prices to buy into gold. The first half of 2016 has proven to be eventful. Similarly, the later half of 2016 is shaping up to be impactful with the spectre of a US rate hike hanging overhead, as well as results of the US presidential elections due in November. This means there may still be a need for investors to hedge the potential risks, and gold will definitely be a medium of choice for most of them. Thus, with all the points taken, this would mean that there could be a strong case for gold to be trending up in the long term. And this wraps up this edition of Phillip Futures webinar. If you are interested to know more about gold, on how to trade gold, and as well as our Trade Gold for Gold promotions, you can visit our websites at www.phillipfutures.com.sg/gold. My name is Jerome Lee, and thank you for joining us. We hope to see you again.